So in the last few chapters, we went over the determinants of a national output, the determinants of price level, productivity, employment level or unemployment rate in the economy. In the last two chapters, we studied the amount of money in the economy and the effect on the price level. Now we bring together all of this discussion, and we will study the workings of the total economy, given that national output, prices, labor market interact with each other. In chapter 33, we will study the interaction of the demand by private consumers, investors, and government, and consumers abroad with the producers of goods and services in the domestic economy. And in this discussion, we will distinguish what happens in the economy in the short run and the long run. Before I talk about the details, I want you to keep two things in the back of your head. So one, in the previous two chapters, we started this discussion of short run and long run effects of monetary policy. And we will see again in this chapter that in the long run, we assume there to be perfect adjustment of all economic actors to prices, to government policy, to the amount of money in the economy. And on the other hand, in the short run, the adjustment will not be perfect, and government policy or changing price level can affect people's decision making. So there will be two kinds of responses, one in the short run, one in the long run. They will be generally a little bit different from each other. In the last chapter, when we discussed money neutrality, and we talked about the dichotomy between real and nominal variables, we should remember that that discussion applies only to the long run. In the short run, we could get a little bit of distortions. And the other point I want to make is that when you're reading chapter 33, remember everything that we learned in this course, both the microeconomic and the macroeconomic part of the course. I think this is a nice review chapter, taking what we learned about individual sectors of the economy, about final goods markets and also factor markets, and the discussion of the aggregate phenomena, aggregate output, average price level, and so on. And the same kind of, so from the microeconomic part of the course, I want you to remember the logic, the way that supply and demand sides of the market interact with each other, what determines the demand and supply curves. I want you to think back to the discussion of changes along a demand curve or along a supply curve, and shifts of the entire demand and supply curve. And from the macroeconomic part of the course, you should keep in the back of your head all the definitions and the relationship between real variables, prices, and amount of money. Okay, so let's start by discussing short-run relationships between variables. We say that in the short run, economic fluctuations are irregular and unpredictable. We do observe business cycles in the real world. Here, you could think back to chapter 28 about unemployment, where we said that in the long run, there is some full employment level which we would expect. But in the short run, there are more sources of unemployment, and even with a given production function, even with a given real resource base in the economy, we could observe higher than usual unemployment in a short time period. And business cycle, when we talk about all of the economic activity in the marketplace, we would observe the same kind of issue. Most macroeconomic variables fluctuate together. This point says that, at least in the short run, there is a relationship between the patterns that we observe with national output, patterns that we observe with employment level, with price level, and so on. Point 3, as output falls, unemployment rises. This relationship is, this statement just follows on the second statement, and it should make us think that the relationship between variables is not one-to-one. There doesn't have to be positive relationship between economic variables. Some variables, such as production level and unemployment rate, could be negatively or maybe inversely related to each other. Okay, so just to repeat, the dichotomy between real and nominal variables and the neutrality of money are only properties of long-run solutions in the economy, not necessarily the short-run solutions. And let's talk a little bit about the relationship between prices and output level. Okay, so according to the money neutrality theory, we would say that there is no relationship between prices and real variables. We will see on the next few slides that yes, this relationship holds in the long run, not necessarily in the short run. When we discuss the workings of the aggregate economy, it is useful to draw a model of aggregate demand and aggregate supply. And when we talk about aggregate demand, aggregate supply, here you should think that we're discussing all of the commodities and services produced in the economy. The demand side of the problem depends on all of the consumption that takes place in the economy. Thinking back to chapter 23, we could say that consumption, so the aggregate output produced is used in four ways of consumption. Consumption by private households, investment by corporations, government purchases, and purchases by consumers abroad. And again, the personalities, private consumption C can happen by households or by government. Investment can happen by corporations, but also by private individuals or by government. Exports could happen through exporting of commodities or exporting of maybe even labor abroad. Okay, and thinking more about the aggregate demand curve, we can say that there is a negative relationship between price level and consumption within each of these streams of consumption. We can say that between consumption by private households and prices, there is a negative relationship. We can call it the wealth effect. Generally, the lower the price level is in the economy, the richer households feel, and the more they're willing to, or they're able to consume. relationship between price level and investment. Again, without going into too much technical detail, we can think that the lower the price level in the economy, the more worth it is for investors to invest. We can say that effectively the price of investing, so effectively the interest rate that investors have to pay on their investment project is lower, and it is cheaper to invest. So with a lower price level today in the economy, investment increases. And finally, between price level and net exports, again, without going into the detail of into the technical details, we can think that the lower the price level domestically for a given price level abroad, if the price level domestically falls, more will be exported. Right? We could understand these interest rate and exchange rate effects even more technically if we talked about the relationship between prices and interest rate and prices domestically and exchange rates with foreign currencies, but that level of technicality is not too important for us. So please, when you're reading this book, focus on the basic understanding of the shape of the demand curve. You don't have to understand the relationship between prices and interest rates and prices and exchange rates. Okay, so generally the shape of the aggregate demand curve is given by the shape of the demand by consumers, demand by government, demand by net exporters. And if there is a shift in one of these consumption streams, aggregate demand curve can shift in the economy. Now let's switch to talking about aggregate supply. So in the long run, we've already said that output level depends on the amount of factors of production available. So no matter what prices are or what the amount of money in the economy, we should expect a fixed, let's say, full employment level of output. And so in the long run, we can think that the aggregate supply curve is perfectly vertical, perfectly determined by the amount of resources in the economy. In the short run, however, we can think that the aggregate supply curve is upward sloping because of some of the distortions or slow adjustment process by in individual parts of the economy. Okay. So generally in the long run, we can say that the aggregate supply curve can shift if there is a change in the amount of labor, physical capital, human capital, natural resources, or technological know-how in the economy. And over time, we could expect this kind of a trend. On one hand, aggregate supply curve shifts to the right because the economy acquires more resources, greater population, greater technological knowledge, and so on. On the other hand, aggregate demand curve also shifts to the right because of a greater number of consumers, maybe greater size of corporations, and so on. And so in general, we would see greater equilibrium level of output in the economy, and really the price level in the economy really depends on the size of these shifts. In this graph, where aggregate demand curve shifts faster than aggregate supply curve, we observe increasing prices in the economy. If aggregate supply curve was changing faster than aggregate demand curve, we could observe deflation, falling price level in the economy. Okay, what happens in the short run? So in the short run, we can we imagine that the aggregate supply curve is upward sloping, because kind of intuitively, if the price level in the economy increases, producers observe that that the commodities that they are producing can command higher prices, and and producers have a greater incentive to produce goods and services. And if there is some distortion between prices of inputs and prices of output goods, we can talk a little bit about stickiness of prices or stickiness of wages. We could say that if producers are holding their wages to workers constant, and if the producers observe that prices of output goods increase, they will have greater incentive to produce commodities, and we can say that then the aggregate supply curve will be upward sloping. So suppose, let's go through some situations that can happen in the real world. Suppose that for some reason aggregate demand curve shifts to the left. There is some shock to demand, perhaps because of people's expectations or because of changing fashion. Consumers decide to buy fewer goods today. So if we originally started at an equilibrium A, when aggregate demand curve shifts to the left, in the short run we would be at equilibrium point B with smaller output level in the economy, lower price level in the economy. And now the question is, would the economy stay at this level? First of all, we should realize that, well, Y2 is not an efficient output level. It's not the full employment output level. With this output level, some resources are not being used fully. Maybe there is more than normal level of unemployment. And we would want the economy to adjust in some way to achieve the original level of output. And it turns out that, well, as the economy moves from point A to point B, some prices become lowered. There is some distortion between how quickly prices in the economy adjust. Eventually, costs, prices of input goods, wages of workers get lowered enough that producers in the economy start feeling that it is that their costs of production are very low. Perhaps prices of output goods have not fallen as much, and producers would be willing to provide more output, whatever the price level in the economy. So we could observe aggregate supply curve to shift to the right. So as a consequence of this adjustment process in prices, aggregate supply curve could be expected to shift to the right eventually, and the economy would move to another long-run equilibrium with the same original output level but lower price level. And this graph illustrates that if there is any change on the demand side of the market, the supply side of the market will adjust itself to still achieve full employment level, full employment output level, and only the price level in the economy can differ. Okay? In the long run equilibrium, we can summarize that the economy produces its natural rate or full employment rate of output, and depending on the exact shape of the aggregate demand curve, we will have some equilibrium price level or equilibrium level of inflation. Now let's look at a situation when aggregate supply curve shifts to the left. Suppose that there is a shock to the input markets. Suppose one resource becomes one factor in production becomes unavailable, and so for any price level, the economy will be to produce less output than before. So in the short run, the market would move from point A to point B. Now the question is, will the market correct itself? Will we stay at this point B, or will we move to the hypothetical long-run full employment output level? And in this situation, it turns out that, well, aggregate demand doesn't have any motive to change. We have a given aggregate demand curve. Unless some shock happens to the demand side, we could end up at this point B as our long-run equilibrium. So here, because the change occurred on the supply side, the supply side doesn't have any other reason to shift, and the demand side doesn't have any reason to shift. So we could end up, because of this shock to the supply side, we could end up at a lower than efficient output level and a higher than efficient price level. We could say that this corresponds to stagflation, which is a situation when there is less than full amount of output. We can talk about a recession here, and we have high inflation. We have higher than normal prices in the economy. To move from this point, it turns out that we would need some government intervention. Remember that aggregate demand curve is a sum of private consumption, investment, exports, and government purchases. So if the government wants to move from this level of output to a greater level of output, one thing the government could do is purchase more goods in the marketplace. So one policy to deal with stagflation would be to increase government purchases, to shift aggregate demand curve to the right, to move from short-run equilibrium point B to a point C. So this was a review chapter of what happens at the aggregate level with national output and with price level. This was a good summary chapter. It brought together many things that we learned in the microeconomic part of this course and many of the definitions and variables that we studied in the macroeconomic part of the course. And with this chapter in mind, we can understand the problems that the events that take place in the real economy and the problems that the government faces in choosing its policy. So this chapter summarized what happens at the aggregate level in the marketplace between the demand side and the supply side. It summarizes the interaction between different kinds of consumers and producers in the economy and the relationship between aggregate output and prices. And this is a nice chapter that brings together everything that we studied in the microeconomic part of the course and macroeconomic part of the course. I think it's a good wrapping up chapter of different topics that we studied, and a good chapter to make you think about macroeconomic events and the role of the government in the marketplace. When you read newspapers, you hear about business cycles, recessions, economic growth, and this chapter lets you understand a little bit more how growth comes about, what's the role of the government in it, and what's the trade-off or relationship between prices and real economic variables. So that's the last chapter that we are covering this semester. I hope that you have learned something interesting throughout the semester. I hope you have enjoyed some of the topics that we covered. I hope that you will not give up on the study of economics, and perhaps I will see you in one of future classes dealing with particular economic issues. Best of luck on the final exam, and have a good vacation.